Hey, welcome back. I ended up buying some Vale after the recent video about iron miners, so here is a more in-depth look into the company. A brief intro: this is the number one iron miner on the planet by production, with high-grade operations especially in Brazil. They have over 60% of the portfolio in iron, with the rest being especially in copper and nickel. They expect some slow and steady growth in production for all three metals and generally have a very good margin, usually on the higher end of the iron mining companies. Financially, we see an okay position, with the current assets not covering the current liabilities, but overall not a lot of debt. The very interesting thing about them is that the equity is very similar to the market cap. That means you basically buy it at or even below the net asset value in a time where the competition is at 1.5 to maybe 2.5 times the equity, so definitely very cheap. The issue, however, is that there are a lot of provisions, which, to be fair, all iron companies have. For them in particular, it's due to a dam failure from a decade ago together with BHP. They recently got a settlement where together with BHP they have to pay around 30 billion in damages over the period you see on the screen. Vale has to pay a bit less than half based on the share in the company that's directly responsible for the accident as far as I know. On the bright side, when this and the decharacterization expenses are over, this company will make even more money. They would be very similar to Rio Tinto today without accounting for any growth, which is a $100 billion company. Add copper and nickel's potential and we can see 7, 8, 10 billion in normal years, which is a ton of money for a not even 40 billion market cap today. Pay, let's say, half of that as a dividend on average, and that's already a yield of like 10 to 12.5% easily and especially sustainably. In Brazil, by the way, the minimum dividend is usually 25% of the adjusted net income, but Vale tends to pay more than that, especially during the good times. They will most likely cut it this year and it won't remain at 15-17% forever, because that's like 6.3 billion already. But something like 5, 6, 7% should be more than okay, even with the fine, which is in line with the other iron companies that might however also cut it pretty soon. As a parenthesis, that 15-17% may be low during the good times, so this company has potential to pay 20-25% or even more at the current market cap. Now, one of you has made a very good point in the comments of the previous iron mining video. China has recently announced successfully using and significantly improving a technology that can purify low-grade iron ore in a matter of seconds without the need for coal. Generally, high-grade ores, like the ones that Vale can mine, which you don't really find that often in China, are currently preferred for producing steel because they require less energy and emit less carbon dioxide during the smelting process. Lower grades you can find a lot in China and the Pilbara in Australia, where the other 3 of the top 4 iron miners are, so can it be an issue for Vale? Well, it's very early to say. It's most likely bad for met coal for sure, but maybe it isn't safe enough, or the extra power you need to crush the iron ore into fine powder, which isn't the case for traditional steel making, may not be worth it. And by the way, we really got to a point where China, which really isn't in a hurry to do it, has to be the one that invents and implements eco-friendly technologies that can revolutionize the planet. We've had grants, policies, R&D and so on for ages and didn't manage to achieve something as big but relatively simple as this. Anyway, we have to think about what it means for the miners, the refiners, the country's demand and so on. This isn't cheap to implement, so it won't destroy the price overnight, but it can deliver long-term savings, so maybe the Chinese government can help and accelerate it. Yes, it can be bad for higher grade ore like Vale's, but on the other hand, it can be amazing for copper and especially natural gas and hydrogen, which I talked about in this video. I'd say probably the best way to play around this no matter what, both with hydrogen and low grade iron, is Fortescue, which I might go for in the near future. Natural gas, LNG or maybe LNG carriers, which I also went for already, can also benefit from this. What does it mean for Vale in particular? It's impossible to know if a potential decrease in iron demand from China, which was already expected but even more now, or other countries that may adopt it, won't be offset by a potential increase in copper. At the same time, if they produce more steel, they'll need more nickel as well, of which Vale is the number 1 or 2 producer on the planet. I don't think it will affect Vale significantly in the next 1-2 commodity cycles, and they have a lot of time and especially money to adapt. adapt. Cut the iron output, invest in copper in Chile, there is a lot they can do and it's not a static thing. They won't wake up in 2 decades and realize they might have an issue. Again, too early to assume, but definitely something to keep an eye on, and thank you for mentioning it. Also in China, we have a potentially massive policy change that should boost the economy. The last time they did this was in 2008 during the financial crisis, after which things went pretty well for the country overall. There are a lot of things in this political sphere like US tariffs that can change the global environment. Again, unpredictable, but can potentially be great for China, Chinese companies, iron and more. As a parenthesis for all videos, but especially commodity companies, keep in mind that there is obviously risk. Issues, especially in China, can really affect the price of the commodity and consequently the iron companies. Vale, back in 2015-16 during the previous terrible times and when the accidents were still fresh, was at like 2.5 per share, so not even a third of the current price. And that's after it fell in half since a year ago. It doesn't mean it will get back to that level, but at the same time, if it's just the normal cyclicality, that can be a huge opportunity. They have a new CEO since September who's already making some changes. We might see a change in strategy, maybe some dividend cuts, cost savings and so on, in case he thinks the company needs to adjust to the current environment. It's not necessarily something bad, it's just an uncertainty for now. Now let's see a valuation. In a very bad environment, with issues in China leading to a big drop in iron prices and maybe a recession, let's say they can make 2 billion per year. With Vale, all the metals that they mine are very tied to the economy, so the down and upside can be very significant. For a ratio of 5, that's a market cap of 10 billion, meaning a price of 2.34. That's a drop of like 70% from the current level, so there is plenty of room to see this fall even more. That's, by the way, very similar to the bottom from a decade ago. But such a price for a still positive cash flow company, or even if they were breaking even, is not something to ignore. Iron and any other commodity is cyclical, meaning that eventually the price will revert. Prices fall, mines close, production drops, and when there is a recovery in demand, prices go up, then production follows and so on. Not instantly, but over like a decade you can see this happen. The last time it happened, Vale went up like 7x in not even 3 years, and that wasn't even such a significant upcycle. In a normal environment, let's say they can make around 6 billion or 5 after all the fines on average, with a note here that this will naturally increase in the coming years as they pay them. For a ratio of 7, that's a market cap of 35 to 42 billion, meaning a price of around 8.5 to 10, so the current level. There is again natural upside and potential for good dividends on top of the potential from copper, nickel, debt repayments, so that 5 can maybe become 8, 9 in half a decade. In a good scenario, with a recovery in demand from China pushing iron, copper and nickel prices up again, let's say they make 12.5 billion, again with natural improvements coming by the end of the decade. For a ratio of 8, that's a market cap of 100 billion, meaning the same as Rio Tinto today, which by the way is very similar when it comes to assets and cash flows. That's a price of 23.44, so very similar to the recent peak. If you look at 2008 or 10 and 11, you'll see this get even higher. The dividend in this case can easily be something like 15-20% per year from the current level, so definitely not bad. As I said, I already bought a bit and I'd really enjoy getting closer to the first scenario because the upside would then be incredible. I bought now because I wanted a bit more exposure to China's policy shift without directly buying Chinese companies because I have plenty of that and I want to diversify. You can watch the Alibaba, JD and Tencent videos if I already posted them, or if not, they are coming very soon, so make sure to subscribe. I think this has potential to be great for many commodities, and if not, this is still a fair price to pay for Vale, and if it continues to fall, I just developed the position. Overall, Vale definitely has potential as an investment. Among the healthiest financials, very good margins, cash flows and so on, especially for such a small size. With a potential recovery in EV demand plus the overall economy in China, iron in general can have a very good time once again. Maybe not the same as the previous peak, which was exceptional, but even a 15-20% increase can be huge for the companies. I'll soon post a video about a very interesting lithium company that should also benefit even more from this. so make sure to subscribe. Again, I have some Vale since a few weeks ago and I think the long-term potential dividends alone are definitely very good. Balancing the risk and reward, even if this can obviously fall like any other commodity company, which I'd love to see, the upside is also very attractive. Again, Fortescue might also be worth a deeper look into. Smaller but even better balance sheet, margins and potential, so not something to ignore. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.